Are junk bonds a risky investment for retirement income? Imagine earning a higher interest rate on your savings, but at what cost? That's what junk bonds, also called high-yield bonds, promise. But are they safe enough for your retirement income? Let's find out. Junk bonds are corporate bonds rated below BBB-. This means the companies issuing them have a higher chance of financial trouble or even defaulting on payments. To compensate for this risk, these bonds pay more interest than safer bonds. But that extra yield comes with some serious risks you need to know about. First, credit risk is a big concern. If the company struggles financially, it might fail to pay interest or even repay the bond's face value at maturity. During economic downturns, weaker companies are more likely to default, which can cause losses. Market risk is another factor. The value of junk bonds can change a lot depending on how the economy is doing, interest rate moves, or investor mood. If you need to sell before the bond matures, you might get less than you paid. Interest rate risk also plays a role. When interest rates go up, bond prices tend to fall. Since junk bonds are riskier, their prices can be more sensitive to these changes, leading to bigger swings in value. Inflation is another concern. If prices rise, the fixed payments from junk bonds may not keep up, reducing your buying power over time. This can be especially problematic for retirees counting on steady income. While junk bonds offer higher yields, the extra income might not be enough to offset the risks. The spread, or extra yield over safer government bonds, has shrunk in recent years, making the risk-reward balance less attractive. Building a diversified portfolio of junk bonds requires careful selection across many companies. This can be complicated for retirees managing their own investments. Mutual funds or exchange-traded funds that invest in junk bonds can help, but they often come with management fees. For seniors seeking stable income and capital preservation, junk bonds pose challenges. Their higher default risk and price volatility can threaten the reliability of retirement cash flow. Many financial advisors suggest sticking with higher quality bonds that are shorter or medium term. These tend to be safer and more predictable. If you are considering some risk for higher returns, it's better to do so through stocks or other income-producing assets rather than high-yield bonds. Overall, while junk bonds can boost income, their risk profile makes them less suitable for retirement income, especially if you need dependable cash flow. A cautious, well-diversified approach with safer bonds is usually the smarter choice for retirement planning.